Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
Swing. All right, hey, welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. Today, it is a pretty good time to be alive in the U.S. stock market. We are going to be doing a timely episode where we talk about the recent COVID-19-induced bear market and the recovery that really has taken us out of the bear market.
Yep, and this is great timing, by the way, because I was actually just in the market for a bear, but I've had a hard time finding someone to sell me one. All I wanted were the limbs, but no one would sell them to me. And I was getting so frustrated, I could not understand why no one would give them to me, because I know I have the right to bear arms.
Okay, that is a dark and funny joke.
Yes, bear arms.
It's pretty gross if you just
It's an amendment
really
joke.
think about it. It's an amendment joke. It's a bear part joke.
It's
You
everything.
checked a lot of boxes there.
It's a good joke.
But no, Josh. No, just no.
Okay, so we're talking about bear markets, and let's look back on this. So let's say you are a bear, and
Okay.
you've been hibernating for the last 5 or 6 months, and you woke up today, and you looked around and like, oh, look, market's at all-time highs. Seems like it's going pretty well. You know, S&P's up about 6% for the year. You know, things are going. What did this bear miss throughout the last couple months?
Well, first of all, they missed me having a bunch of hair.
That's right. That's the
Bear
first
hair.
one.
I actually made a bet. If anyone is listening, may have seen the video on Facebook or YouTube. I made a bet. I think it was about April or May, that until the S&P 500 reached all-time highs again, I would not cut my hair.
Yes.
And it got a little hairy.
It did. It got hairy, and it made our bosses a little nervous.
Yep, it was because this could have, historically speaking, bear markets are not quite this short, as we'll talk about, and there was potential for a
Could have been a
full-grown
braid
man
involved.
bun.
Yeah, could
little
have been braided.
Rapunzel. So anyway, I have a haircut now, and everyone is happy. So what have we missed if you had been hibernating the last 5 months? A lot. A freaking lot is really like the summary, the high level, to 30,000 feet. But to clarify, when we are going to be talking about the bear market and subsequent recovery and all that right now, we're going to be referring to the S&P 500, the most well-known U.S. equity index, and that's the measure most people are familiar with. Now, the tech-heavy NASDAQ, another index, already hit all-time highs much earlier, and the Dow, so more value-oriented, has yet to hit it. But we're going to be talking S&P.
Yep.
Because that's generally what people are going to talk about for the bear market.
Right. And just to be clear, so there's bear markets and recessions. We're going to talk a little bit about what a bear market is, but a recession is talking about our economy. So there's only one kind of definition there.
Yeah.
2 consecutive quarters of
GDP.
negative GDP means we're in a recession for our economy. But a bear market could be, you could have a bear, like you said, a bear market for the S&P 500, a bear market for the bonds. I don't know. Maybe if it drops far enough, you could have a bear market for the NASDAQ. So we're clarifying, we're talking the S&P 500 today. Okay.
And the bear market definition is actually, so a 20% drop from a recent high.
Yep.
And then you really can't say you're not in a bear market until you've eclipsed that high again.
Okay.
So so from the all-time high for the S&P 500 closing was on February 19th, and we'll go through a full timeline of everything that happened. But February 19th, all-time high. March 23rd was the bottom, and we were down about 34% on the S&P 500. So that is the trough.
Yep.
And so that was the bear market. But you do not know, you're not really out of the bear market officially until you've eclipsed those all-time highs, as we just have. But it technically started at the bottom.
Right.
So that's kind of an interesting way to look at it. So I think it's probably helpful to go through a timeline of exactly
Yeah,
what
let's do
happened.
that.
So last year, 2019 seems like a long time ago.
Man, that was just a year ago.
I know. So late in December, we started hearing the term coronavirus.
Yes.
And it was really talking about a new virus that was starting in China.
And that really confused me because a lot of people called it the novel coronavirus.
Right.
And I was like, what book is this?
I know.
And I didn't know what was happening.
I was thinking, like, I have a novel. Do I have a virus in my novel? But
Yes.
that's a naval.
Naval. And
So,
that's a boat, so I don't know where we're
It's a
going.
whole other thing. So, yeah, that's kind of started at the end of last year, but it really did not spook too much of U.S. equity market and all that. So the stock markets in the U.S. anyway closed the year up more than 30%, generally speaking, following the last year, the Fed tightening, sell-off that we had in December made for a really strong 2019.
Yeah. In 2018, it was almost a bear market.
Correct. It was 19.8% or whatever.
Really close.
So lots of movements over the last few years, but 2019, really, really good year.
Yep.
End of the year, started hearing this news, really didn't affect the markets very much. So ended the year strong. So then mid-January 2020, so this year, President Trump signed the Phase 1 trade deal that had been anticipated for a while with China, and that took some uncertainty off the table.
Yep, it was a good thing.
It was a good thing and answered some questions anyway, and it took some uncertainty off the table, and that boosted markets even further. So come end of January 21st specifically, the U.S. registered its first COVID-19 case. And that was actually a business traveler from China, so he had been in an area where this was more prevalent.
So what happened to him?
I kind of fell off the record. Like you were the first one.
I mean, is it kind of like if you think back to like the Chicago Cubs and you have what's his name who caught the ball and the foul ball that caused them to to miss out.
Yeah,
on
he had
the
like
World
death
Series.
threats and stuff.
Yeah, it's like is this guy's
guy.
like forever life going to be tainted with this, or is he kind of anonymous for his safety? Where like we do know there was a case, but it was inadvertent. Obviously, he didn't know. Otherwise, he would have taken precautions. I just was wondering if anybody was like tracking that.
I don't know either. So that was January 21st. Flash forward a little bit, early to mid-February, the virus started spreading further, and there was concerns that it was really going to start picking up the pace in the U.S. So on February 19th, the S&P 500 peaked at a level of 3386.15. So that was the peak, February 19th. Now, mid-March, so in about a month later, cases really started picking up. And the market had already started to sell off.
Yeah. So the market peak was the day after my birthday, just as a reference point. So really, my birthday was the highlight of the year up to that point, and then it was really downhill.
It's all
right
downhill
after
from
that.
there. Remember that.
Yep.
Josh's birthday, peak.
Then it was down.
So the Fed reacted really quickly to the markets selling off, not just equities, but fixed income markets and everything. So the Fed, in the middle of March, cut short-term interest rates back to zero, where they were really in the coming out of the global financial crisis for the first time since then, and they reinstated quantitative easing, which at a high level, we should probably do a full episode on this at some point.
Yes.
But at a high level, it's the Fed going into the fixed income open market and buying fixed income securities in various different types, various different asset classes to instill some liquidity and to kind of continue to bring together buyers and sellers when there really weren't any buyers. People wanted cash, so they were dumping everything.
And that was part of the problem is when in March, when things started to slow down or shut down, banks and people who were lending money started holding on to that money. Right. They did not want to get rid of cash. And when that happens, there are businesses that have these rotating, rolling lines of credit that need a flow of cash, and it's, they pay it back and then get some more and pay it back. And when that cash freezes up, it really hurts our economy. So that's what the Fed was stepping in for. Is they said this fixed income market is in danger of really freezing, which then will cause kind of a rippling effect all through our economy.
Yes.
If there's not that certainty that I can get the cash that I need to borrow when I need to borrow, especially from businesses, that causes problems.
And that's the reason for the interest rate cut.
Yep.
So you take things, it was 150 basis points off in one cut.
Yes.
Emergency cut too. This was not a planned meeting. So what happened was between those two parts, you have quantitative easing, which is really the fourth round of quantitative easing that we've ever gotten from the Fed. And three were, coming out of the global financial crisis, and then we had the fourth, QE4, what we had here. So between that and the interest rates down to zero, the Fed stepped in really, really big, but the market's still kind of free-falling at this point, right?
Well, so the fixed income market more or less stabilizes.
But the equity market was still free-falling
equity
until
market was going down.
March 23rd was the bottom.
Yes.
So the S&P 500 went from, remember, 3386 down to 2237. Was at the bottom on March 23rd when it closed.
Quick math in my head, that's about 33% down.
It's like a third.
Yeah.
That's a
crazy.
Third of the S&P 500 market cap was lost. And that took a span of 33 days.
And we're talking about it bottoming. But on March 23rd, if you can think back to that day, no one knew that was the bottom.
No.
And that's part of this whole discussion on bear markets. we can't say it's the bottom until we officially come out of it.
Exactly.
Because we could go back down again and say, oh, there's a new low, which becomes the trough, that bottom part. So you can't define the bear market until you're looking backwards at it and say, here's the top, here's the bottom, and here's the day we recovered.
Yep. So yes, we are back in what's called a bull market now.
Yep.
Now that we've re-eclipsed the all-time high before, we have a bull market that we can date back to the bottom.
Yep.
So very interesting the way it's
33
calculated.
days, you said, though.
But 33 days, we fell 33%. And let me tell you, it was not 1% per day, as you kind of could do the math there.
Yes.
There were some days where things just went, there was one day where things were down like 6%, 7%, 9%. I think I remember one day. Really rough time. So fell 33% in 33 days. March 23rd was the bottom. By the end of March, the U.S. and most of the world was really on some form of stay-home order. People were losing their jobs at a rapid pace, and that really culminated when we saw unemployment numbers come out for April, 14+%, almost 15%, which is horrible.
Yes.
And then we got a Q2 GDP reading, which is an annualized quarter-over-quarter number, so keep that in mind, of minus 33% as well. If you take out the fact that it was annualized quarter-over-quarter, it was more like a quarterly reading of -9, but still really, really bad.
And they annualize that for whatever reason, who knows. But as a reference point in 08-09, that didn't even get to a 10% drop at the worst point of that.
Right.
And so just to compare the two, the worst annualized reading in the last recession that we had was about just under a 10% drop in GDP.
Yep.
We had a 33% drop in GDP.
And I think the first quarter was the first quarter was also negative, which is what made it a recession.
Yep.
So and that was like a -5. So two negative quarters made it a recession. Right. But those are bad readings, and those are readings that we've not seen anything close to in our lifetimes, but not really at all since the Great Depression. We're not talking recession.
Yeah, Great
We're
Depression.
talking back to the 20s and 30s.
Yes.
Which is bad.
Yeah, and even the unemployment rate. So you think back to 08-09, the Great Recession,
was like, what, 10%?
It peaked right under 10%. And now we went to 15%, and we did it in a couple months, not through 2007 through 2009,
right.
A year and a half really of downward trajectory. It
We're
was
recording
a quick drop.
We're recording this in August.
Yes.
This will be released in August. The latest reading we have was from July, and it was still 10%.
Yes. Yeah, we're still higher than we were at the worst point of 08-09.
It's crazy. So
and we're all-time highs in the market.
So we're getting to that. So on March 27th, so we're kind of, working our way through March 27th, Congress signs the CARES Act into law, which is really the Coronavirus Aid and Relief Act. There's a lot of other acronyms.
I know we've talked about it before, but I think my retirement job, something to do to keep me active, will be naming bills.
Acronyms?
Yeah, giving good acronyms to bills. So I think I'll just kind of be one of those lobbyists that just shows up and does something like that for them.
So you
got to be creative there.
So at a high level, Josh, what are some of the major provisions
so
in that?
The CARES Act, the big things they did is it had enhanced unemployment benefits. So you get unemployment from the state. Each state has their unemployment system. The federal government said, we're giving some additional unemployment money on top of your state unemployment.
Not
and
really
it was
just some
$600.
either. Yeah, a lot.
And depending on what you were earning, it could really move the needle on what you get from unemployment. Most state unemployments provide you, 50, 60% of what you were getting prior to losing your job. You add additional $600 a week on top of that, then you may be earning as much or more than you were taking in before. But the whole point of doing that was, one, for ease. Calculating how to just get you back to 100% would be just impossible. It was hard enough for states to enact this $600 flat per week, more or less having some sort of crazy calculation. So that was ease for them to implement it as quick as possible. And then two, even if they are paying you extra, the hope is that you will be kicking that into the economy. You will be stimulating the economy because our economy is driven by spending.
Yep.
So that was the other reason for that. On top of that, they gave the stimulus check. So $1,200 a person, that varied based on income and stuff.
Yeah.
And then you got some additional benefits for kids. But for adults, it's $1,200 a person. Those are the individual things that were part of the CARES Act. And then they did large corporations. They did some loans and some, I don't want to call them bailouts, some additional money for large corporations. And then the big one, which you heard a lot in the news, was small business support. Yep. So the PPP loan, and there's a couple other grants you could get. Those were there to provide for smaller businesses with fewer than a couple hundred employees, giving them the ability to keep them running because they're the ones impacted the most.
PPP standing for Paycheck Protection Program.
Yes, and the idea there is you're not supporting the business, you're supporting the employees. They may had to lay off or furlough or something where they can provide them that paycheck and ongoing income while we're trying to figure out what's going on.
Yep. So that totaled $2 trillion from the CARES Act.
Yes.
Now you combine that with what we talked about with the Federal Reserve's actions, and that was about $4 trillion.
Yes.
So combined,
$6
out of our back pocket of being able to print our own debt, really, we came up with $6 trillion in a couple weeks.
Yep.
That's a lot.
Yeah. And, obviously interest rates being super low, when we talk about the government printing money, what they're doing is creating money and then creating treasuries or bonds that they will sell to generate that revenue. And the reason that the U.S. is still able to do this is we are a very secure place to borrow from. So if another country borrows or buys our debt, there's a good chance we're still going to be around and be able to pay back that obligation. Yeah. And so, especially at super low interest rates, it's great for us from an interest standpoint. It's great for them because we still have higher interest rates than most of the world.
Yep.
We don't have negative interest rates or anything like that. So we created, like you said, about $6 trillion to help us get out of this self-made recession.
Correct.
Because that's really what it was. We shut the economy down.
Yeah.
We did that to slow the curve of the virus.
Yep.
And it wasn't like some part of our economy did something or was faltering. We just said, pause.
And that is why the government stepped in such a big way, is because even very much unlike 0809, where that was clearly, there were faults in the financial system and the banks were
industry.
making bad choices.
Yes.
This was a total, no one made a bad choice. This is us, the government, saying, hey, we're shutting things down, so we're not going to let, really, you're not going to fail from paying your bills or eating or whatever, or your business isn't going to fail, and the markets aren't going to fail. All of these things, the government's saying, it's not your fault. We're going to let it slide. We're going to get things by, is what they're saying.
Yep. And they, on top of the CARES Act, some of the things we didn't mention, but they postponed repayments of student loan.
Yep.
So you don't have to pay student loans now. I think they pushed it through to the end of the year or right around there.
Yeah.
And it's, it's in a sense, it's pushed down there for you. You're not like accruing interest on that. It's just paused.
Right.
And then the same is true with renting. They put some protections for people renting so they wouldn't get kicked out.
Yep.
They're trying their best to say, we know there's an issue here caused by us trying to prevent the virus from overwhelming our healthcare system. We will do our best to help alleviate some of that pressure.
Exactly. And so we talked about the CARES Act. That is, we actually have if you want to learn a little bit more, we have a full episode we'll link in the show notes where we talked about that when it actually happened. Another episode that kind of ties in with what we're going to talk about next is oil. So you may have heard back in middle to late April, oil prices, quote unquote, went negative. Well, based on the futures trading is how, we got negative oil prices, but that is another thing that we have a full episode on you can check out.
Yes.
We'll link those below if you want to go into more detail, but that caused, on April 20th, when oil prices went negative, that caused oil companies to look increasingly risky and unprofitable overnight, which put even more pressure on that sector of the market. So craziness that we just never thought we'd see, all of this stuff.
Who would thought that businesses were getting paid to hold the oil for an additional amount of time because there was nowhere to deliver it to?
I thought you filled up your shed.
That
when
was
they were
work.
negative.
I'm still holding it.
Yeah, still holding it.
I'm playing the long game. And I saw a lot of olive oil, but apparently that was not part of this whole thing. So I don't know what to do with
Pushed
that.
the wrong ticker.
I guess.
So that is pretty much as all of the negative things were happening. So after that point, things started opening back up slowly. And it's still slowly opening up around the country, but people have gone back to work. The unemployment rate has come down. These kind of things, people can go back out and kind of do more things, and travel's picking up and spending money is picking up and those kind of things. So throughout all of that time, the stock market bounced really hard off that bottom. And since then, on August 18th, so 5 months pretty much to the day from the bottom, the stock market is up 51%.
Wow.
51%. Now, if you understand how stock market price changes go,
Yes.
you'll know that that equivalent drop was only 33%, but that rise was 51. And that's because of your starting point, which is what you're dividing by. So that 33% drop is the same amount of points as a 51% gain off the bottom.
An easy way to understand that is if we use a simple number like 10.
Yeah.
If you drop it down to 5, that's a 50% drop.
Yep.
But to go from 5 to 10, that's
100%.
doubling it. That's 100% to get back up. So that's just a quick way of thinking how percentages work when you're going down and back up.
Yeah.
So if you ever need to think of it that way.
So August 18th, we not only hit the record intraday close at 33.8978, which was greater than 33.8617, I think it was the prior record close, but we also eclipsed the intraday, which was a few points higher. It's just amazing that in only 5 months that happened. And it's one of the fastest recoveries we've ever seen. That is just crazy. But that's what happened. So that is the last 5 or 6 months of really highlights of where we got to be where we got today. So talk about some historical bear markets, Josh.
Yeah. So again, like we mentioned, a bear market is a drop of 20%. Now, there's a lot of debate. There's no hard line about this rule. Is it 20% intraday, 20% at the end of the day closing? How do you do it? So depending on what you read or who you look at, they may have a couple more or less bear markets historically. Like I said, 2018, 19.8% drop.
Near bear market.
Yes. Do they count it? Do you round it up? Depending on the person, those different. There was an Associated Press article, and they had, since 1945, there's been 12 bear markets. All right. So that's, a reference point to give you an idea of how often it happens. Since World War II, the average bear market has been 14 months with a 33% decline on average throughout that. So again, 5 months was this one with a 35% decline. So very fast, very quick to get there. But that's kind of interesting to think about how it compares. Also, there's a Yahoo Finance article we'll link in the short notes that has this same data as well. So how does this compare? It was the fastest decline.
Yeah, 33
to get
days,
there.
right?
Yeah.
Well, so from peak to trough, it was less, obviously, to the 20% mark.
Yep. It's also one of the shortest. There's also one in the 1990s that was about, I think, 3 months long.
Okay.
So it's pretty quick.
Yeah.
But again, it's unusual to be that quick. Usually, like I said, it takes over a year to get back out of this. So it's really interesting to think that we went from the longest bull market.
Yep.
We were in the longest bull market, and that was followed by one of the shortest bear markets.
Right. And now we're back in a bull market.
So it's just, our economy and our markets have experienced a lot of firsts recently, and we're not sure going forward will it be, but it's fun to participate in it.
So, Josh,
Yes.
I am so excited that I get to tell you the dad joke of the week today.
Okay.
I've been preparing this one since I decided to put together notes for this episode.
So when you found it, you wrote it down.
Exactly.
All right.
All right, Josh. What do you... I can't say it without laughing.
He just knows the answer. He's going to laugh.
What do you call a cheese? No. What do you call cheese?
What do you call cheese?
Without any friends.
Without any friends. I don't know. What do you call it?
Provolone.
Provolone. Oh, I like it.
Also, delicious cheese.
This is good cheese.
Makes great sandwiches.
That's my go-to at Subway when I eat Subway.
You eat fresh? You eat the fresh
I
provolone. So, provolone. So, Josh, now that you're lightened, your mood is lightened.
I like it.
Talk about what drove this recovery. What's the main drivers that you can think of?
So the big driver of this recovery was the government stepping in. Because really, if you think about what happened, in a sense, closing down our economy for 5 months, without government intervention, it would have been a whole lot worse. If there wasn't any support for people as they were sitting on the sidelines with no income or not enough income because of unemployment, due to no fault of their own. Because, if you get unemployed, you can go out and hunt for another job. Well, when everything's shut down, there's no jobs anywhere. Yep. So, without the government intervention, that was a big part of the recovery. Monetarily, like we mentioned, $4 trillion in stimulus went through from the Fed. The largest Fed balance sheet as a percent of GDP, it's around 33%. So 33% of our GDP is being held on the Fed's balance sheet.
That's crazy.
This is quantitative easing. Low interest rates helped as well. Low interest rates, again, they don't show up as a dollar term, but what they do is help everybody with the cash flow. But what it does do is it reduces the amount of income the Fed or the government gets when they are lending money overnight to the banks. The fiscal policy is the other piece, $2 trillion like we mentioned in the CARES Act. That's, I think, in my mind, the bigger piece that actually, because our economy, again, is built on consumer spending.
2/3 of the economy is from consumer spending.
If it wasn't for that money coming into individuals where they could buy their food, continue to pay their utilities, and kick that money into the economy. And, you know, we joke about this here. If you ever visited a Home Depot or a Lowe's, a Menards during the shutdown,
oh my goodness,
man, it was crowded. But that was part of it is people got some extra cash and they were forced to sit at home. And as you're sitting at home looking around, be like,
in a room,
man, you know what? I need to fix this place up if I'm going to be stuck here for a while.
Right.
Or you needed a little extra space to get away from some of your family, so you added on to get. You know, my man shed really needs picked up so that I can stay out there a little longer.
The he shed.
Yes. So those are the two big pieces that drove the recovery.
Yeah, I think another one is how like kind of the market is built. So specifically talking about the S&P 500 is what we've been referring to mostly, but we did mention that the NASDAQ, so I think mostly large tech companies, hit all-time highs earlier in this recovery.
Yeah, they're up over 20% for the year.
Yeah. Oh, yeah.
Regardless of what happened.
Right. Exactly.
That's
so
crazy.
Tech is what has driven this recovery, and if you think that big tech, so think Apple, Microsoft, Amazon, Facebook, Google, that's the big five that I'm thinking of in my head. Their business models are pretty impervious to this kind of shutdown. Mm-hmm. So obviously, people were still. You were probably still paying for your Office 365 subscription for Microsoft, or businesses were, or investing in cloud because everyone's working from home.
Yeah.
Facebook.
You need to communicate. You need to have this stuff at home, so you need to have the subscription.
Facebook, everyone is still using. They're probably using Facebook. Well, they were using Facebook a lot more because that's how they're communicating with people and keeping updated. Instagram, those kind of things. Everyone's on the internet, Googling still stuff as much. Lots of YouTube watching while things are shut down. Amazon became more important than ever, and the stock price has shown that.
Yes. If I can't go to the store,
you're just going to order
have
it
it
to your
shipped
house.
to me.
Exactly. In 1 or 2 days, and it was a little longer. When
they did stretch it out. Yep.
But still crazy. And Apple, you're still using your services that you're paying for on your Apple phone, or you're buying a new phone or whatever because you've got more money in your pocket from stimulus. So those kind of business models were kind of impervious to the shutdown. And because they are huge market weighting in the S&P 500, because the S&P 500 is a market cap weighted index.
Explain that to me.
So there's 505 companies, which doesn't make sense. There's 505 companies in the S&P 500.
That's like the Big 10 having more than 10 teams. In the okay.
So there's 505 companies in the S&P 500. The top 5 stocks combined that I mentioned, Apple, Microsoft, Amazon, Facebook, and Google, those top 5 in terms of size, market cap is share price times number of shares out there. So how big your company is in terms of how big it's traded. Those represent 1/4 of the index. 5 companies out of 505 represent 25% of the index.
Okay.
So what that means is that their business models doing well, which means their financials did well, which means their stock prices went higher, sent the markets higher because they represent such a large portion of the market.
So I know over this time frame, because I see it on the news all the time, Tesla did really well. Their stock price has gone crazy.
Berserk.
But they're not as big of a company as these are.
They're also not in the S&P 500.
Right. So like a price move like that, though, doesn't have as big of an impact because they're a smaller company. So if they were in the S&P 500, but they're only, however many billion-dollar market cap, their 260% growth or whatever would not have as big an impact as if Apple had a 5% growth on it because overall they make a bigger piece of it. So I got this cap-weighted thing.
Apple moving 5% just drives... that's a huge move for the market in general. So when we're talking about the S&P 500, if you think of those 5 companies really being the bulk of the gains, because in general, if you look at those 505 companies, well over half of those 500 companies are still down year to date. They're below zero. They're negative returns.
Still caught back
but their market caps are much smaller. So that negative has meant the market overall is now back to where it was. So that is crazy. But I will link a really, really cool article from Visual Capitalists that describes this visually and market caps and all of this stuff of these companies. Okay. And I'll link that in the show notes. It really it explains it really, really well. We're not sponsored by Visual Capitalist. Hey, shoot us an email if Visual Capitalist is interested.
Yeah.
But super good way to look at this. But overall, big tech has driven this rebound. It's been amazing.
So as I think about that, I remember seeing, like, for instance, energy was down like 60 to 80%, depending on some of those holdings. But because they're a smaller grouping there, they didn't pull the whole S&P 500 down 60%.
Right.
And the fact that these were doing well helped cushion that, how bad energy really was, because no one was driving anywhere. No one was flying anywhere. It was bad. I think
the S&P 500 energy sector is like 3% of total weighting. But technology is 20-some%. 25% or something. So the technology moves obviously drive the market up a lot bigger than, like, you could cut energy in half.
And no one knows.
And it would make a lot less of an impact.
Yep.
So overall, those are kind of the two things that I'm thinking that drove the recovery. Yes, the opening is going okay. The virus numbers are going well. But the government was huge. That's a lot of money being flushed into the economy from the government and the Fed, as well as how the market works together. And being that those large weighted companies really have done exceptionally well through that. The two main factors, I would say, are those. Now, people are out spending more money, but those are what really got us to where we are today.
Yeah, because the spending still isn't what it was before.
No, it's not. It's going to take some time. But the question, Josh, is what happens next?
Well, good. I actually, speaking of Amazon, I was waiting. It was delayed, but I got my crystal ball now, so I can tell exactly what's going to happen next.
Is that one you rub and talk
you got to
at?
look right at it and shake it. And so here's the deal, though. We don't know, obviously. We can't tell you where the market's going to be. But I do know, historically speaking, given enough time, the market will be up and our economy will continue to grow. Because, again, the market's driven by the innovation and growth of individual companies. And regardless of what's going on around them, there's innovation. In fact, in times like this is actually where we see the most innovation. 2007 through 2009, when we had the last big recession, there was a lot of new ideas and new companies that came out of that when they saw opportunities. So if you ask me what's happening next, given enough time, I would say we have a stronger new growth in our economy because there's new innovation.
So if someone were to say to you today, not taking their financial situation out of the picture and their exact timing with retirement, is it a good time to invest in the markets considering what you just said? You would say?
If you have a long time horizon, yes.
You would say yes.
Yes, especially knowing that compounding overrides and defeats timing every time. That I would say, if we're talking retirement, down the road, years from now, now is a great time because we know over the long run, historically, the market over 5, 10, 15 years, that the times is positive far outweigh the times is down.
Exactly. So I think another thing that we need to keep an eye on of things that happen next is it seems likely that we'll have some sort of additional fiscal stimulus bill probably in September. Now, there's an election coming up. Don't know if anyone knew about that. But I think that's causing a little bit of the headbutting that we're seeing in the weight on what this bill is going to look like.
And it's a good thing I'm not a bettor, because I probably would have bet money they would have had something figured out before their August recess.
I know.
Because it just seemed like from a political standpoint,
bad politics.
I don't know.
Yeah, so don't bet on. We're going to go home and go on vacation.
Yeah.
And we're going to leave you guys all sitting here with your money.
I was surprised. But I do agree. I think the need is still out there for some sort of relief or help for a large percentage of our population. So, I would agree that there's a good chance for some sort of fiscal stimulus or some sort of, even if it's just a continuation of some of the programs already enacted to help along the way. Because we still aren't, again, we're still not back to where we were.
Right.
There's still a need.
And those details are constantly changing. So we'll have to see what things look like in September, but stay tuned and we'll have an update when that happens. I would also just say that it's probably safe to expect continued choppiness, continued volatility to remain pretty high, pretty elevated, at least into and probably through next year, but probably until we have some vaccine and some level of herd immunity from the virus, because that's really what caused this. And combine that with the fact that there is an election in November. There's just a lot of uncertainty.
There's a lot of unknown.
So if the market were to be smooth and up and to the right between now and through next year, I would be surprised if it's that smooth.
Yes. Yep.
Not saying it won't be up and to the right, but I'm saying there could be some dips and choppiness.
And again, looking back now, like so the S&P's up about 6% for the year.
Yeah.
That includes a 35% drop.
Right.
And so again, choppiness is there, but we're still up 6%. So it's still up and to the right, but it had a little
huge
trip there along the way.
Exactly. Also, something that I'm keeping an eye on from an economic and research standpoint is that at some point, all of these trillions with a T, not billions. We're talking trillions now. All of this money is going to have an impact on the overall economic landscape of our country. There is potential for real inflation at some point. Not for a while, probably, because things are still slow to open. But that's a lot of easy lending, easy borrowing.
Yes.
And that is going to cause some inflation at some point. And also, we just want to keep in mind that this is a cycle. So, like Josh said, we had this really, really short bear market. We had a long, long, long bull market, a really, really short bear market, and now we're back in a bull market. But these things are cyclical, and we're technically still in a recession. So
until we get
positive GDP growth. So we just know that these things are going to come and go. These bear markets are going to happen, bull markets are going to happen, recessions are going to happen, expansions are going to happen. And we need to be able to keep the long-term focus here.
Yep. And what's always interesting, too, is when you look at the stock market performance in a recession, it's really positive a lot of times because of that trail. So usually you're out of the bear market before the recession ends because you need 2 quarters of growth, which is 6 months. Well, normally your stock markets has recovered by then. So, bear markets and recessions aren't always hand in hand, and nor do they follow suit. So you're right. But both are cyclical, and both have a tendency to have longer positive sides, shorter downsides.
Right.
Because, again, as we innovate and grow, there's more of that time frame. But it's always, like you said, keep in mind that that's normal.
And also keep in mind that the stock market is not necessarily a reflection of what's going on right now. The stock market is forward-looking. Every single stock in the stock market that's publicly traded, investors or managers are looking forward at what all of these holdings and what all these companies are going to do in the future and saying, this is what I think this company's worth today. So this little dip this was a big dip, but this dip we're in 2020, it's less valuable to them than the next 20 years or whatever of growth and innovation that the company is going to bring. So that's why the stock market is up right now, despite the fact that we have 10% of America unemployed.
Yes. It's looking forward past this saying, okay, where are you heading? How are you doing? And they pay attention to balance sheets. They pay attention to where you're currently at, but they put more weighting to where you're going.
Yes.
You're right.
Wow.
That was good.
That is a lot. It's been a crazy year, Josh. I got some more gray hairs.
It has definitely been stressful for you and I. This was the first major downturn we've experienced in this industry. We were both alive through the last one, but we weren't in the industry yet. And so for us to experience it, it was definitely new and different. And also to do it from home for part of it. You and I were working from home and doing the podcast virtually together. It
was a learning experience.
It was definitely different. So it's good to be on the other side, looking back and learning from it. And that's the other key is how can we as advisors and investment professionals say, what did we learn from this last one? How can we improve our business, our industry, and how we manage our clients' money based on what we learned from this experience?
Yep, I think we all learned a lot, and hopefully this bull continues for a while before we have another bear. We will have another bear. We're fairly confident in that. But let's enjoy the green while it's green.
Yes.
So as always, check out our free gift to you. It's a brief list of 8 principles of timeless investing on our website. These are overarching investment themes meant to keep you on track to meet your long-term goals. It's a nicely done PDF you can download for free just to kind of check up on where things are on that. Josh, how can people help us grow this podcast?
Yes. First of all, subscribe. That way you know when we push out a new episode every Thursday. If you're on Apple Podcasts, please leave us a review. That just helps us rank higher so more people see it, and we can hopefully help them as well. If you have any ideas, have any thoughts or questions, something we brought up you want more detail on, shoot us an email. Go to our website, and there's a spot there to contact us. You're emailing us at hello@theinvesteddads.com. And then also, if you know somebody that was asking about this bear market, share this episode with them. Make sure they get a chance to hear it.
All right. Thank you. We'll talk to you next Thursday.
All right. Talk to you later.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks and Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks and Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks and Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.